Just a year ago, Carvana, an online used car retailer, was being heralded as a disruptive company and the future of buying cars. But now, only 1 year later, Carvana is failing and facing a very real risk of bankruptcy. Its stock price has crashed 97% in just a year, leaving everyone wondering how the company has collapsed in such a short time. Carvana's bonds are trading at over a 30% yield, which reflects the extreme risk of defaulting on its debt that the company is currently facing. For context, a 10-year US Treasury bond is only giving a 3.75% yield. Carvana's largest creditors have also agreed to act collectively in the event of restructuring, which is typically a defensive move done before potential bankruptcies. But what makes this story even crazier, though, is that Carvana was valued at over $60 billion just a year ago, and now the company's value has plummeted to under $1 billion today. Articles were coming out left and right a year ago, crowning Carvana as a pandemic winner and a disruptive company. Wall Street investors could not get enough of Carvana as the company's market cap skyrocketed. While most reasonable people are cautious about used car dealers to say the least, Wall Street, on the other hand, was all in on Carvana's business pitch. And all it took was car vending machines to get investors lining up to invest their cash. Wall Street thought that that was a $60 billion idea at one point, despite the fact that Carvana has never had a profitable year. And now nearly all of that $60 billion valuation has been wiped out, as the company is on the brink of bankruptcy, leaving everyone wondering how Carvana failed so quickly. Because up until 2022, Carvana was a quickly growing company. Since the company IPO'd in 2017, its stock price quickly climbed as it sold more and more car units each quarter and gained more market share and brand awareness among consumers. But while Carvana was growing before 2020, this growth trajectory paled in comparison to what would come next for the company. Because a perfect storm of factors would push Carvana to unimaginable highs beginning in 2020. As pandemic lockdowns took place, online businesses benefited in a great way as consumers were stuck in their homes and began to purchase more and more things online. This was also the case for Carvana, as many people weren't even able to go to a car dealership to purchase a car in person. In addition to the e-commerce boom benefiting Carvana, fiscal and monetary policy also became extremely loose, with the Federal Reserve taking interest rates down to nearly zero. Combined with the US government providing stimulus checks for consumer relief, created an artificially high spending environment. The extra cash that consumers were being given and the low interest rates on any loans that were being taken out made it very easy to finance purchases like a car. A third major factor benefiting Carvana in 2020 is that the lockdowns also created many supply chain shortages all throughout the global economy. In particular, the semiconductor chip shortage was very widespread and greatly affected the auto industry. As consumers who were stuck at home bought up tech products both for work and entertainment, this created much higher demand for the semiconductor parts used to make those products. This increased demand for semiconductors was also combined with decreased supply, because many manufacturers had bottlenecks in their factory production lines from lockdowns. This is important because semiconductor chips are a core component in car manufacturing. So this caused a major decline in the amount of new cars that were being manufactured, which made it extremely difficult for potential buyers to find new cars. Since many consumers were unable to get new cars to purchase because of the shortages, they would instead buy used cars. With the supply of new cars being low, consumer demand being high, and financing being easy, this all combined to push used car prices up significantly. Used car prices increased drastically to the point where many cars that people owned had actually appreciated in value compared to what they were worth a few years before. I can't emphasize enough how extremely unusual that is, because cars are normally a depreciating asset that lose value the longer they are owned and used. As an online used car retailer, Carvana was thriving in this new environment where consumers were more easily able to buy used cars, more likely to buy them online, and to do so at a higher price. This perfect storm of factors pushed Carvana's stock price to over $350 a share and above a $60 billion valuation. While these factors helped catapult Carvana to all-time highs, they would also end up becoming the company's downfall in many ways. It's true that Carvana's sales were growing quickly, but the company was still wildly unprofitable and burned through cash rapidly. At the time, investors were willing to look past this and focus on the company's sales growth. This attitude from investors, combined with the low interest rate environment that the Federal Reserve was creating, made it very easy for the company to raise money to compensate for its cash burn. Because of this, Carvana was actually able to raise a substantial amount of money in the bond market. This is not typical because usually bond investors are primarily interested in lending money to companies that are profitable and have stable and predictable cash flow. This is simply because of risk. Unprofitable companies are much more likely to default on their debt and not be able to pay the bonds back. But the loose monetary policy environment made it possible for Carvana to raise a substantial amount of money from the debt market from investors. However, these good times for Carvana would not last long. The extremely unusual financial conditions of 2020 and 2021 began to shift as the Federal Reserve realized that inflation in the economy was out of control. In order to fight the rising inflation, the Federal Reserve signaled at the end of 2021 that it was planning on raising interest rates in order to tighten the flow of money throughout the economy and slow down the rampant consumer activity that was taking place due to the low cost of borrowing money. Used car prices are heavily tied to interest rates as many consumers purchase cars through a car loan. Higher interest rates on car loans slow down consumer demand for cars significantly, as higher interest rates end up forcing many potential customers out of the market, as loans simply become unaffordable for many potential buyers. This is actually an even bigger problem for Carvana because one of their sources of revenue is actually securitization, where they are originating the loan for customers and then selling that loan to finance partners. Approximately $1 billion of the company's revenue came from this process in 2021. And in 2021, a massive 54% of its $4,537 in gross profit per vehicle came from the other profit category, which includes its loans. The issue with Carvana's reliance on securitization for its gross profit is that in a risk-off environment where investors are cautious, they are a lot less willing to buy the loan securities and take on that risk, which lowers the price that Carvana can sell them for to its finance partners. This potentially could be a major revenue loss for Carvana in the high interest rate environment we are now seeing. But despite the Federal Reserve signaling its intentions to raise interest rates throughout the economy, Carvana did not slow down its expansion plans and spending at all. They actually doubled down on their spending to the frustration of investors. The company followed its aggressive expansion plans beyond what its sales were actually capable of supporting, which has now saddled the company with debt and excess capacity that they can't take advantage of with the now slowing demand. Carvana also made the mistake of buying too many used cars at elevated prices to stock its inventory. They even admitted in their shareholder letter for the third quarter of 2021 that they were facing significant operational constraints due to buying so many cars from customers. As Carvana was rushing to build its inventory in 2021, the higher used car prices would become a double-edged sword for the company. They had previously benefited from their existing inventory appreciating in value and then being able to sell it at an elevated price. But now they had to restock their used car inventory at elevated prices as well. As the used car bubble has now begun to pop and prices are going down, Carvana has inventory that it bought a few months ago that it's now selling for a loss. The Manheim Used Vehicle Value Index, a gauge of wholesale market prices for used vehicles, has hit its lowest point since August 2021. And there is potentially more room for used car prices to fall as well. Carvana failed to adjust to the changing conditions and interest rates in the economy, and acted as if the abnormally low interest rates were going to continue forever. In the beginning of 2022, the company even made a deal to acquire the physical used car auction house Odessa by borrowing $3.3 billion from bond investors at an expensive 10% interest rate. This tripled the company's interest expenses during the first 9 months of 2022 compared to the year before. This has increased the company's already high cash burn. Carvana has only ever had one single quarter with a positive net income, and its net losses have been rapidly increasing the past several quarters as it has taken on more debt. This year alone, Carvana has lost $1.45 billion so far as of the third quarter. Because Carvana did not stop borrowing money and was not controlling its aggressive spending, they're in a very dangerous spot as they are quickly running out of cash and have no way to continue operations without taking on additional debt that they will have to pay for with very high interest, which will further burden the company. To make matters even worse, Carvana has had a terrible user experience for its customers, with increasingly widespread instances of customers never even getting the titles to their cars that they buy online. This is such a widespread problem reported by customers across many states that it has prompted legal and regulatory issues for Carvana in Michigan, Illinois, Pennsylvania, Florida, and North Carolina. The state of Michigan has even suspended Carvana from operating in their state after several complaints from customers in Michigan about title problems. And with continued problems being reported in other states, it's very possible that others will follow suit in suspending Carvana's ability to operate in their respective states. The Better Business Bureau has hundreds of complaints against the company, and it has a dismal rating on their site. Many of the reviews online detail terrible customer experiences with Carvana. This one here mentions that Carvana delayed their car delivery 5 times, which forced the customer to pay for a month of car insurance on a car that was not even delivered to them. The notification about the delivery delay was always sent out an hour or less before the delivery was supposed to happen as well. This customer review details how the car that was delivered to them had a check engine light on within 2 weeks, despite the fact that it supposedly passed Carvana's inspection and screening. And the car was not correctly registered, forcing the customer to deal with getting the registration handled on their own with the DMV. And this review talks about how Carvana only provided them with a temporary registration, and that after that registration expired, they failed to get another temporary registration like they were supposed to. Carvana has been completely unresponsive since then, leaving the customer with a car that they can't even legally drive. Because Carvana is facing legal and regulatory issues, its debt is so high, and they are wildly unprofitable, Carvana's bonds are trading like the company is a near-term bankruptcy risk. The company's creditors have agreed to negotiate collectively, which indicates that they are preparing for a possible restructuring like what would occur in a Chapter 11 bankruptcy. Carvana is estimated to have enough cash to survive just a few more months of operation. If it does not find additional funding, the company will have to file for Chapter 11 bankruptcy and try to restructure. Carvana is now taking measures to try and slow down its cash burn with widespread layoffs, but it's likely a case of too little too late, and the company is still in a lot of near-term danger. Many institutional investors and hedge funds have been exiting Carvana stock completely, as the stock getting delisted from a Chapter 11 bankruptcy is a very real risk. But be sure to let me know your thoughts on Carvana's situation in the comments below, and leave a like on the video and subscribe to the channel for more finance and investing content. Thanks.